The NASDAQ is down about 1% today, and my next guest is warning the rebound in big tech stocks has been too far, too fast, as you can see on that screen there over the past month. He says it's time to hoard your cash and then pounce on the next correction, which might not be too far off. Paul Meeks is with Harvest Portfolio Management. He is the CIO. So today, a bit of a fit. It appears they're throwing over bond yields, 10 years up at 460 right now, Paul. But is that the gist of your argument here or more?
That's a perfect executive summary. And first, with the bond yields, if we get back to 5, where we had been not too long ago, then Katie barred the door for not just tech stocks, but all aggressive growth stocks. So I am worried about it. I think the big move that we've had off the bottom, right, when we troughed on April 9th, for many tech names, indeed has been too far, too fast, because some of the companies in my coverage are impacted by tariffs and others are not. But those impacted by tariffs did not see any tariffs, or not much of them, because their quarter ended March 31st, and we didn't have Liberation Day until April 2. So I think we'll get a better read on the fundamentals in about the second or third week of July when they announce their June quarters. So I'm still very cautious about rates, about the economy, and particularly about geopolitics.
That's why I chuckled when I saw your recommendations, because I thought that you were going to say, Oracle and Cisco and, IBM. And instead, you're in Robinhood, AppLovin, which has like a 42 PE or something, 50 something, and Take-Two.
So that's interesting. I am more worried about having companies that will be pulled into the tariff fiasco. I always want to buy stocks lower than higher. But I do think they have, at least the ones that you mentioned, Take-Two Interactive is being driven by the release next May with Grand Theft Auto 6. My favorite idea that you mentioned is AppLovin. And yes, it's pretty expensive, but it's also diversified and then concentrated their business again. So now they're only in advertising. It's about $1.2 billion per quarter revenue, 81% adjusted EBITDA margin. Last quarter grew at 71%.
Wow. And it's in the green today. Yeah, go ahead.
Yeah. I don't think that that one is necessarily a value prohibition. And so I try to always watch relative and absolute valuations, but I'm now more interested because macroeconomics, geopolitics has come to the fore, that I want to have companies that are away from that potential damage. And I like those very much.